What's going on, everyone? This is Jordan with Conquer Trading and Investing, and we got a very exciting episode ahead of us where we're going to look at a lot of interesting stuff. We're going to be ready for both, and we're only going to trade what is happening. I want to break down for you what is happening right now in front of us. Most importantly and interesting is this chart here of the S&P 500. We're also going to take a look at the NASDAQ, the Dow, and a lot of other interesting macro news and charts. Also going to share a really important conversation, something that I have possibly been leaning towards. As you all have known, I've been building the case that perhaps this market is really just getting warmed up. Maybe we're going to see the big four. Maybe we're going to see the S&P 500, gold, Bitcoin, and the DXY, the US dollar, all trading up at the same time in the new sweet spot trade. Are we headed back towards that? Or are we getting here ready to roll over, break out of this channel over here to the downside? And is the market going to catch up to the economy? We're going to be ready for both, and we're only going to trade what is happening. I want to break down for you what is happening right now in front of us. And that is really simple. We are being rejected right over here right now. We're being rejected up here off of the 3147 resistance. We'll take a look at that in just a second. But I want you back here over the weekend looking at the 8-hour chart, taking a step back. This is showing here in red. You see the New York session. New York just sold off hard the whole day. Now we had the quadruple witching, which was the expiration of options across the board, $1.7 trillion in total. Did that add to the volatility? Is the market perhaps a little bit worried of further pressure to the economy due to further increased lockdowns and or a second wave of the virus? Perhaps that's starting to build in a little, but this is overall pretty still bullish. I'm looking over here at still a consolidation pattern developing here on the S&P 500, although it looked like it broke out of a bull flag today, which I'm going to take a look at with you because I was able to get a trade off on that. But right here on the greater scheme of things, it looks like we're still in a consolidation period over here. We could continue to trade within this channel over here early next week, or we could be breaking early to the downside. And if that does happen, if we take out this support down over here, the support's coming in around 30, 33, right? Maybe that's up a little higher. We'll find out at 30, 40. In that area, we expect some pressure there. And if we lose that, we are coming down and we are testing the trend line support. This trend line over here, by the way, is a pretty big level in the markets. If we lose this level, at that point, we will be pushing the sell side very hard, perhaps even looking for a test or a break of March lows, but that's not what's happening right now. Right now, we still have technically a very bullish structure that continues to develop over here. And as we're going to take a look at right now, we're going to take a look at this video between Grant Williams and Luke Roman discussing if it's possible that we see the Fed continue over here to just push this markets with no reason to stop it. And we're going to see what they have to say. That is a very interesting conversation. I want to take a moment and share this with you. This is from Grant Williams and Luke Roman on the Talk Global Macroeconomics podcast. And really interesting point of view shared about whether or not it's possible that the Fed will just continue blowing this bubble because they have no reason to stop it, and what it would look like where this were coming to a conclusion. Let's check this out together.
We're talking about, okay, what do they do if this thing runs away? But we may be at the point now where why would they think like that? Why would they try and stop this thing running away? Because at the end of the day, they realize now if it stops going up and starts coming down, they're on the hook.
Did you hear that? He's saying, what reason would the Fed have to stop the momentum they've created in the markets? Because if they do try to stop it, right? If they start taking money, quantitative tightening once again, anything they could do to put the brakes on the economy, what that would do, that would cause the economy to fall pretty quickly. And then the Fed would have to step in to come to the rescue. So they don't really have any type of incentive to go ahead and take to put their foot on the brakes at all and could keep this economy running.
Right? They're going to have to spend an unlimited amount of money, which they've said they're willing to do. I can't believe they want to do it because they realize that they're going to need all these bullets at some point. So maybe this is like, okay, well, we've already shown that we don't take the punch bowl away. Why don't we go and put another fifth of Jack Daniels into this thing? And right? I mean, it's
And then he goes on to say, not only do they have no incentive to take away the punch bowl, why not add another shot or two, right? And really get this thing going. It's possible we see definitely new all-time highs on the indices. And if that's happening, we want to be a part of it. What happens if they start taking money off the table? What would that do to the stock market?
what possible reason do they have to try and stop this running away now?
Well, what's fascinating when you look at the stock market in Venezuela, Argentina, and you look at it in nominal terms, it's fascinating the shape that it has at a very similar point where we're at here in the U.S. It gets really violent. The moves, and I would argue we've seen two violent moves so far. The first one wasn't nearly as violent as the one that we just saw. But my expectation moving forward is that we're going to continue to see these violent waves. They definitely don't go anywhere in real terms, but as far as in nominal terms, they kind of go up, but they're really violent. So I guess my expectation is that we're going to see a new all-time high, and then that's where the Fed's going to say, oh my God, we're putting too much in the system. Let's just ease off this a little bit, and then you're going to get the cataclysmic whipsaw to the downside, only for them to...
You see that? That's why we're aware of both sides of the market. But right now, it looks like we have the potential to keep humming along here, looking for higher highs on the S&P, the Dow. Will they get to all-time highs and join the NASDAQ? Will the NASDAQ continue its gains? That's what we're looking at right now, and here's what could cause that to come to an end.
And then that's where the Fed's going to say, oh my God, we're putting too much in the system. Let's just ease off this a little bit, and then you're going to get the cataclysmic whipsaw to the downside, only for them to add the next unprecedented amount of liquidity into the system.
That's a really great point, Preston, because I think it was Chris Cole recently, I think I read maybe where, and I hesitate to use it, but it's just the easiest example, and it was the one he used. If you look at the Weimar Republic, what happened to stocks in nominal terms, the average person, and myself included, I've made this mistake when I first looked. I said, oh, well, the easy trade is you borrow a bunch of marks and you buy stocks and you own them in Germany for free. And he said, but you have to really look as these violent reversals that you talked about. The reality was the only way to get from point A to point B and gain wealth was to be unlevered, actually, because if you were levered either way, those swings cleaned you out in between. So I thought that's a really interesting point. Again, I don't think the U.S. is going Weimar, to be clear, but I do think there are, when you look at the fiscal side, when you look at the wealth inequality side, when you look at the social unrest side, when you look at what happened with the Treasury market in March, I think we're moving towards sort of a Venezuelaization of the U.S. market.
All right, now I want to take a look at some important levels as it is Saturday, and we really need to be getting that top-down perspective. I'm going to roll out over here to the weekly time frame, and what I want you to notice, we're first here focused on the S&P 500. I want you to notice that over the last 3 weeks, you could take the high, which was at 32, 36, the low, which printed this week at 29.35, and you could see that right now we are closing in the middle. You could see that we're closing in the middle. So you take the high of the last few weeks and the low of the last couple of weeks, and we're closing the week pretty much in the middle. Now, we still have and continue to have a bullish formation here in the markets. So we are expecting, or looking for rather, not for this to roll over and be the start of something bigger yet, but we're looking for an orderly pullback that continues. Over here, you could take a look at the 3-day time frame, and you could see this nice channel that we've been watching over on the 8-hour. You could see it over here, and it continues to be in play, and we are towards the upper half of it. As we come back down, if we come back down during next week, and the closer we get into this area, right? And as long as we're above this support over here in the 2873 to the 2860 area, this whole pocket over here that we'll be looking at, as long as we're above there, this still would be a pretty bullish structure, any test of that. And it's possible we start looking at maybe making a range in the markets, consolidating sideways in a pretty big range going through the summer. And then is really going to be the fall that decides what happens next over here, whether or not we are going to continue pushing new all-time highs, or whether or not we are going to roll over if we start seeing further pressures developing in the fall. Now, over here, looking back on the daily time frame with you, you could see this pretty clearly what's going on right now. And you could see this is providing perhaps opportunity to lean in next week and make some buys here. You could see that why the true trend is still showing an upward impulse. As we're crossing down to the lower half of the channel, you could see that a negative impulse is starting. Now that could either be a good time, right? Like it was over here to lean in on the long side coming out of it, or it could mean that we are not only beginning to roll over here, but that we lose this area of the trend line, test even further, and then who knows what develops from there. We'll have to check in. Right now, definitely being rejected over here by this horizontal resistance this morning at 31.47, and then again coming back down though into an area of local support. It looks like it's still consolidating in a pretty bullish formation over here, especially if you look at the higher time frame. You could really see it. And does it look like it's beginning to roll over yet? It's too soon to say that price is rolling over. It's too soon to start getting aggressive on the long side. What we would need to look over here, this is where you want to focus on the 4 hour. And you could see that coming down into this support, or perhaps even lower into this trend line support, which we have peaked below, that would put us into this horizontal support over here. Those are all good opportunities to develop, to look to continue to buy in to the S&P 500. And if we're able to resume over here, perhaps off of this support or off of this local support we're trading on right now. We'll see what happens on Monday. We'll be looking at it closely. I do want to cover some important things with you. I do want to take a look at this U.S. macro surprise index, which has showed both huge misses to the downside as well as now to the upside. It makes a lot of sense that it's kind of hard to put any type of forecast or number on what's going on right now out there. Also want to look at the gap between the macro and micro at its greatest ever. Now, could that continue? Which one is going to catch up to the other? We're going to find out soon whether or not we have the jaw shut and the two close out to each other, or perhaps either the market or the economic surprise index catches up to one or the other, but they are too far spread apart right now. I want to take a look because we did have all of the expirations happening today. This morning, as the June S&P futures contract expired, you could see the large spike up. This is on the 5-minute time frame. And then after that, the continued selling pressure. Here's a look at the Bloomberg Dollar Index. The dollar ended the week higher. It's been up now 6 of the last 7 days and up 2 weeks in a row. We're seeing that dollar firming. Bitcoin ended the week lower, but apart from Monday's dump and then pump, it ended in a narrow range, and it continues to consolidate really nicely. Not only Bitcoin, also gold is doing the same exact thing. Gold surged today back above 1750, and it is close here to breaking out to new yearly and 8-year highs. Watch the S&P, watch Bitcoin, watch gold here, all looking to be breaking out. And we're seeing the dollar joining in also. Are we perhaps coming to a new area over here where we do, like earlier in the year, all through January and February, we saw not only the S&P trading firmly with a strong uptrend at all-time highs, also the US dollar was trading with a strong bid at it, trading up that whole 2-month period, getting as high as 100 before pulling back, and then eventually going back up towards 103. Don't forget the Fed's balance sheet shrank by the most since 2009 this week. Now, is it the fact that the Fed pulled away some liquidity that we saw the dip in the S&P? Is the S&P going to be able to handle it, or is it going to be asking for more? This is over here, the Fed's balance sheet. You could see over here, 2009, when those large deductions were taken away. Now, this is something I'm not an expert on, but that's why I'm looking at it and always looking to learn. I'm looking in green at the Fed's balance sheet expansion and then red in reduction. And you could see over here, 2008 was when we first started QE, the first ever QE. then I don't know what happened here on these reductions. And now you go over here to the right and we'll start seeing that happening now. Interesting to watch how the market reacts as liquidity is being taken away over here. You can see over here, this area was the quantitative tightening when the Fed was trying to withdraw from its QE and the market broke as it, but that's exactly what happened over here. And then I want you to go over here and look at a chart here of the Y2K back in 2000. And then also what is happening now on the NASDAQ. And you can see they are completely different patterns, where back in Y2K, the market was never able to go ahead and make new highs as it is now. As I state that, though, that's not happening all around. I want you to focus in over here on, we'll start here with the NASDAQ 100, and you could see why it's at all-time highs. The Dow is not. It's made a lower high over here and is possibly looking to begin rolling over. That's interesting. Keep an eye on it. Same thing here with the S&P 500. It did make a lower high. And is it possible now that it is getting ready to roll over? Well, we're going to find out day to day.
I think we're moving towards sort of a Venezuelization of the U.S. market, but it's not that bad yet. And the other thing that is, I think, critical is that the U.S. still has the ability to produce virtually everything it needs at the right price. So for a perfect example is shale, right? As the dollar collapsed 90% against oil, going from $12 to 120 or 150 bucks over however many years. And what we got out of that was an incremental 8 or 10 million barrels a day of oil. And there's a lot else that the U.S. could do where ultimately that's what would stop the hyperinflation from being completely currency destroying, like a Weimar, in my view. Which is not to say it couldn't get very inflationary, but I just don't think it can destroy the currency in the same manner.
Interesting arguments. Grant?
For me, the outcome is uncertain, but what I'm just listening to are two very smart, very knowledgeable guys discussing whether the US is Venezuela or Weimar Germany. Right? But that's the important thing for me, right? Because you're both saying it with a straight face, and they're both possible outcomes. That's a really, really important thing for people to understand. 10, 15 years ago, A, we wouldn't have been having this conversation, and B, if you had done, it wasn't a possible outcome. It was kind of some fantasy that you were thinking about, well, let's just game this out just for fun.
I hope everyone has a great weekend. Happy Father's Day to all the fathers out there. Happy Father's Day. Enjoy your time with your family. I'll see you all next week. Take care and be safe.